What if I told you ETFs could very well be one of the easiest and most powerful ways for you to invest your money in the stock market? Even if you've never invested a day in your life, by the end of this video, you'll know how you can start investing in ETFs with very little money and very little research. You'll even know how you can outperform the majority of professional fund managers with just one or two of the options we'll talk about today. We'll cover exactly what ETFs are, how to go about choosing the right one for your situation, and we'll even go through the step-by-step process on how to purchase one of these ETFs. So with that, let's dive in. ETF is short for Exchange Traded Fund. They're described as exchange traded because investors are able to buy and sell ETFs on a stock exchange like the New York Stock Exchange, and they're called funds because they consist of a bundle of stocks, bonds, and other investments that are packaged together into one investment option, very similar to a mutual fund if you've heard of those. A good way to think of an ETF is like buying a tray of your favorite assorted fruits at the grocery store. Rather than having to buy all of the different fruits throughout the store, which would cost you a whole lot more, you're able to purchase this one option that gives you a little bit of everything for a cheaper price. Similarly, a single ETF can contain hundreds or thousands of stock or other investment that give you a great amount of diversification in one purchase without having to handpick stocks yourself, and they're usually geared towards a specific investment sector like technology or a specific index like the S&P 500. So if we look at one of the most popular ETFs that track the S&P 500 called SPY or SPY, we can see that it's currently trading for about $440 per share. This means that for this price, you can own a piece of the 500 biggest and most successful companies in the US, including names like Apple, Amazon, Microsoft, and Google. This diversification across so many companies helps to spread your risk and provide stability to your investment portfolio over time. Now, you might think, Austin, I really don't have $400 to invest right now. If that's the case, then let me tell you about fractional shares. There are a number of brokerages, including Robinhood and Charles Schwab, that offer investors the ability to buy a portion or fraction of a share if they don't want to buy an entire one, meaning that you can still invest in any stock, bond, or ETF you would like with as little as $1 to get started. Then, as you get more comfortable with investing more, you can increase your weekly or monthly contributions to grow your portfolio over time. If you'd like to get started with investing in fractional shares, make sure to check out the link in the description below to open an account with Robinhood, where you can also earn a free stock worth anywhere between $5 to $200 for doing so. Now that we have a basic understanding of what an ETF is and how they work, how do you decide which one is right for your situation? Currently, there are over 2,700 different ETF options available out there, so it can be very daunting to try to sift through all of them. A really good resource to help you get started with some basic research is to go to etfdb.com. This site is a database that you can use to filter through ETFs and find the ones that fit your investing goals. A good section to jump to on this site is the popular ETF section, which has categories broken out by investment goals like growth and dividend investing, as well as different sectors you may be interested in, like real estate and healthcare. Now, I've already gone ahead and done research into some of the most popular ETFs that I'll share with you in just a second, but if you want to do any further research into the ones we go over, feel free to look them up on the website by typing the ticker symbol of the ETF in the search bar here on the top right. Now, the biggest factor in deciding the right ETF is simply knowing what your overall personal investment goal is. The four main categories I would break most people's goals into would be the following: growth and income, and preservation. These categories work as a sliding scale that can change for you over the years depending on how long of a time horizon you have to invest, as well as what your personal risk tolerance is. On the left side of the scale with a growth focus, this would typically be for you if you are in your younger years with a lot of time to invest and you have a higher risk tolerance. The ETFs that are popular in this category would be QQQ, VUG, and IWF. The investments in these ETFs tend to be more technology focused, and as a result have quite a bit more volatility from year to year, where the good years are really good and the bad years can be really bad. Over the past 10 years, ETFs focused on growth have averaged around a 14 to 16% annual return. As we slide over on the scale and move into the growth and income focus, these tend to be the real bread and butter of investing for most people when it comes to overall return performance. The most popular ETFs in this category are SPY, VOO, and VTI, and these are the real MVPs when it comes to outperforming the pros. Each of these ETFs are what's known as an index fund, meaning that all they do is track and follow the performance of key market indexes like the S&P 500, which is the 500 largest companies in the US. The returns of this particular index are often used as a benchmark for fund managers to see if their actively managed funds can essentially beat the market, and there have been numerous studies showing that even though fund managers can do better in any 1 year of investing, about 80 to 90% of managers cannot consistently beat the market over an extended period of time. So by foregoing picking individual stocks and simply investing in something like SPY or VOO, you will outperform the majority of professional investors over the years. Pretty cool, right? And these growth and income focused ETFs have averaged about a 10% annual return over the past 10 years. Moving on now to the income focused ETFs, these are popular among those who maybe have a shorter time period to invest and who are a little more risk averse. Some popular ones in this category are VIG, VYM, and SEHD. The holdings in these ETFs are focused more on generating income for investors by choosing companies that are well established and pay out dividends. These ETFs provide less overall volatility in the investment while generating a more predictable stream of income through dividends. These dividend payments can even be reinvested back into the ETF to buy more shares, further compounding the growth of the investment. Over the past 10 years, these ETFs have returned an impressive average of 9% annually when dividends have been reinvested. Last on our scale are the ETFs focused on preserving wealth, which mostly consists of bonds. The most popular ones in this category are BND, AGG, and BNDX. These ETFs would be for those who have already built their wealth, are likely retired, and are looking for the least volatile investment to preserve that wealth while also providing a small return in order to keep up with the rate of inflation. The average return of these ETFs have been about 2% over the past 10 years. Now, with all of these average returns, it can be easy to look at our scale and quickly jump to the conclusion that investing in the pure growth ETFs is the best choice. That could be the case, but one thing that is very important to remember as an investor is that past returns are not guaranteed to predict future results. This means that all of these averages could very well be different in the next 10 years, so the biggest key is to continue investing consistently and diversify so that your investments can grow over time as the economy continues to grow. However, if I were to only pick one ETF to invest in for the rest of my life, I would have to choose SPY as my personal favorite. I believe this is a really set it and forget it investment option that I can trust to do well over the decades, so I'll be continually investing in this ETF leading to my retirement. Now, to wrap things up, I'll show you exactly how I buy my ETFs. I'll be using Robinhood in this example, so make sure to use the link in the description below to open your own account with them if you would like, but you can use any taxable brokerage account or IRA if you have one to do this exact same thing. Once you're logged into your brokerage, simply find the search feature and type in the ticker symbol of the ETF you want to purchase. In this case, we'll look at SPY. Once this is pulled up, you can select trade and buy, and a screen will pop up for you to enter your order. From here, you can enter the number of shares or fraction of shares you would like to order, or you can select the shares option in the top right and switch the buying method from shares to buying in dollars to enter a specific dollar amount. Once you've entered the amount, you can select review, and Robinhood will have you confirm your order by reviewing the order details and swiping up to submit. Once the order is filled, then congrats. You've purchased your first ETF and you are on your way to building your investment portfolio. You can even set up recurring investments for that ETF if you want. This will ensure you're consistently adding to your investments over time with no additional work on your end. But that's it for today. Thank you so much for watching. I hope this video was helpful, and if you learned something new, make sure to like the video and subscribe if you want to learn more. Let me know what other questions you have about ETFs or investing in general in the comments below. And until next time, stay happy, stay humble, and take care.